assignment risk. This is, when I talk about selling options, this is kind of one of my favorite things to talk about. And the reason being is because for me personally, I think it's one of the most important concepts. Anytime you're selling an option, you have assignment risk, right? When you're buying an option, you have the right to purchase stock at your strike price, assume we're talking about a call, up until expiration, if you exercise that contract. If I'm selling an option, I have the obligation to sell that stock if I get assigned. So any short option, anytime we're selling a call or selling a put, we have that assignment risk. We have that obligation to fulfill our contract, regardless if we want to or not. So if we're getting assigned on a call, we are obligated and we have to fulfill that obligation to sell 100 shares of stock at our strike price. We will receive that assignment notice from our brokerage firm. We might receive it the day after expiration. We might receive it the Monday after a weekend. If expiration is on a Friday, let's say, we might get that assignment notice on Saturday. It may not come until Monday. It may not even come until later in the week. There is no rule or regulation or law determining a timeline for when you must receive that assignment notice, right? That being said, luckily in this day and age where everything is digital and computerized, I don't know that there's any situations anymore where people wouldn't receive their assignment notice in a timely manner. But just a little fun fact is, as my colleague would say, only sellers get assigned, right? Here's the big risk for me, and here's the thing that it's not that I like talking about it, but I think it's very, very important to understand after hours trading and the risk that that has on short options. I'm a Chicago boy, which means that in addition to having excellent taste in food and pizza, our markets close at 3 p.m. Central Time. That's when our equity ETF markets close. All of the equities, most of the ETFs. Indices close typically 15 minutes later, so 3:15 Central Time. But as you know, the world doesn't stop spinning, right? The equity world doesn't stop spinning at 3 o'clock Central. There's after hours trading. There's after hours news. And that's kind of where all this comes from. The after hours news. Let's say I am short, and I'll keep it simple. I'm short a $50 call. I'm obligated to sell that stock at $50 if I get assigned. Stock closes on expiration Friday at, $50 call. Stock closes at $49.50. My option is out of the money by 50 cents. I'm not expecting anyone's going to come to me and, knock on my door and say, hey, Mark, I want to buy that stock from you for $50, even though it's trading 49.5 in the market. So my call option is finishing out of the money. I'm expecting it to expire worthless. I'm not expecting an assignment notice, right? And that's the end of the day. I expect to wake up Monday morning, look in my portfolio, my account statement, and see that premium that I collected when I sold that $50 call, 100% of it is in my account and ready for me to, do whatever I'd like with it. Buy a bunch of eggs, I guess. That's what I'm expecting. Now, the reality might be that at 3:15 or 3:20 or, whatever time it may be, the company that I was short those options with comes out with earnings, or they come out with some news release. I know just recently there was something about a company being added to the S&P 500, and that, naturally, impacted the share price of the security. The point being is that if news comes out and that $49.50 stock price at expiration now is trading $55, then the option buyer has the option, pardon the pun, to exercise that $50 call. Even though it finished out of the money at 49.5, they still have the right. As an option buyer, you've got the right to exercise your contract at any time, for any reason, up until expiration. Now, your trading firm will have certain policies in place telling you the hours of their exercise window. Their policy will state that you can exercise as a long option holder, as a buyer of a put or as a buyer of a seller. You can exercise your contract on expiration day up until whatever it may be, 15 minutes after the close, 30 minutes after your close, 45 minutes, whatever it may be. It's going to vary from firm to firm to firm. So different trading firms, different brokerage firms have different cutoff times. So, homework assignment number one for everybody is to contact your broker or look them up online, find out what that cutoff time is for exercise. That's rule number one, or homework number one. And the reason that you want to know that from a buyer's perspective is if there is that after hours news and my contract is technically out of the money, but I still want to exercise it, how long do I have to do that? All right. Is that clear with everyone? Now, how this applies to sellers is that just because my contract closed out of the money at 3 p.m. Central, closed out of the money by 50 cents, doesn't mean that I am not going to be assigned. If stock in after hours rallies up to 55, I likely will be assigned on that contract. And where I was, expecting to come Monday morning and see that profit in my account statement, not only do I not see that profit, but now I see that I'm short stock at $50 and the stock is trading 55 in the market. So on top of it, on top of a $5 stock loss that I certainly wasn't expecting, but now I'm short stock and assuming that I'm approved to have short stock. Now on top of that $5 loss, I've got interest rate charges by my broker. I've got fees for short stock that I'm charged by my broker. So I was expecting to see a couple $100 of profit in my account, and instead now I've got thousands in losses. The lesson for this is that short option writers, whether it's a call or a put, or even if you're in a spread, and you could even be a buyer of a spread, whether it's a call spread or a put spread, you're buying or you're selling. The point is that anytime you have a short option, you have an assignable position. And I know that it sounds, kind of redundant or maybe elementary, but the only way to avoid assignment is to not have an assignable position. All right? And the only way to not have an assignable position is to not have any short options. What all this means is that prior to expiration, maybe it's just a couple minutes before market close, and whether you're in a call or a put spread, a credit spread, short call, short put, you may choose, or it may be wise for you to choose, or you might even just want to think about choosing, closing out that short contract right before the market closes. If you can buy back that short call that is out of the money, that there's a very low probability of you getting assigned on that contract and you retaining 100% of that premium that you collected. But there's always that chance that something goes nuts. And under those circumstances, that's where you really get hurt. There was a gentleman that I was speaking to, and this sticks out in my mind. This was years ago. He was investing in this famous electric car company, and he had a short put spread. He had sold a put spread on it. And I don't quite remember the specifics, but both options finished out of the money. He was expecting to simply retain all of that premium that he collected, number one. But number two, because he was trading a spread, he had assumed that he had that he had limited risk and limited reward, right? Defined risk and defined reward. That's one of the reasons why people trade spreads. And typically that risk is going to be the difference between the strike prices minus the premium that you collect. So if you sell, for example, a $10 put spread, the difference in strike prices is $10. So you've got $1,000 in risk, $10 times that 100 multiplier. You've got $1,000 worth of risk minus whatever premium that you collect. So this individual had on, if I recall, I think he had like 70 put spreads that he was short, something like that. But the point is that he was expecting that, he had a defined amount of risk. And I don't remember if it was earnings that came out or, a tweet that somebody had made or whatever it may have been. But there was a huge movement in this electric car company stock over the weekend. And whereas this investor was expecting both legs of his spread to expire worthless, his short puts got unexpectedly assigned, and he now found himself long tens of thousands of shares. I want to say it was like 70,000 shares of this electric car company, and the stock was down, I don't know, like 15%. So whereas he was thinking he had $70,000 worth of maximum risk, and I think he woke up Monday morning and he was down like $1.25 million, some crazy amount. And the reason I'm bringing this up is he was asking, how can that happen? My spread expired out of the money. And that's exactly what this is. After hours trading can affect your position as an option seller. It's critical that you realize this. And for that reason, a lot of investors, whether it's retail investors, market makers, what have you, will buy back any short contracts that they have to close the position just prior to expiration. You remember a nickel, if an option's trading for a nickel, it's literally $5, right? Real world dollars, $5. So is it worth maybe spending $50 or $100 or, depending on how many contracts you have on, is it worth spending a little bit of money, eating into some of that premium that you're expecting to keep in your pocket for peace of mind? I like to use the phrase, think dollars, not cents. So don't worry about the nickel necessarily that it's costing you to close out this contract. Worry about the thousands that it may cost you by not closing out that contract. All right. Now, this isn't a recommendation. I'm not telling you that this is what you should do. I'm not giving you advice. What I am telling you is it's something from a perspective of education. It's something that happens, not all the time, but it's something that does happen from time to time. Be cognizant of it. Understand the risk and understand how to minimize that risk. All right, is that clear? Pin risk is the last item that we're going to talk about, and it kind of goes hand in hand with those after hours. Pin risk is simply saying, look, I've got a position on, and I don't know the likelihood of my short, call, or put getting assigned. And maybe I'm short a $50 strike, and stock up until maybe the hour before expiration, maybe it's trading between 49.75 and 50.25. So it's kind of, going back and forth above and below my short strike. So I don't know if I'm going to get assigned or not. I'm uncertain as to what the probability is. So again, it kind of goes back to the concept of, there's another phrase that we have on the trading floor that was, when in doubt, close them out. If you don't know if you're going to be assigned and you're concerned about the possibility of assignment, simply close out that contract, right? You need to be aware of that potential for unexpected and possibly even unwanted assignment. And the way to avoid that is to simply close out that contract.